So right now, completely beneath the surface of the global financial system, there's actually a silent emergency unfolding inside the world's ultimate safe haven. Welcome to this explainer. Today we're going to unpack the hidden plumbing of international finance. We're looking at how a distant central bank in Europe directly impacts your personal portfolio, your index funds, and honestly, even your plans to buy a home. It's a truly fascinating look at the unseen forces that are driving global wealth. Just a few weeks ago, this exact message went viral across private financial channels. Quote, "The Swiss National Bank is quietly preparing to dismantle a 30-year policy. To foreign institutions holding negative yield arbitrage, your funding window is closing. Protect your capital." End quote. It was posted by an anonymous, verified institutional trader in Frankfurt. And you know what? Most people completely ignored it. I mean, it sounds like dense jargon, right? But within just 14 days of this post, something unprecedented happened. The Swiss central bank executed this massive policy shift, their currency absolutely surged, and foreign capital began rushing out of global debt markets at a rate we literally haven't seen in decades. So what actually happens when the world's free money machine shuts down? Well, that's exactly what we're here to uncover. Okay, let's dive into this with Section 1, the anomaly, breaking all economic rules. To really understand the shockwaves hitting the markets today, we first have to understand why Switzerland is just a total economic paradox. In conventional economics, central banks are supposed to balance inflation and employment, but Switzerland, they operate on an entirely different set of rules. Usually, you lend a bank your money, and they pay you interest. That's how it works. But for nearly a decade, Swiss banks did the exact opposite. Why? Because the Swiss franc is the ultimate safe haven currency. Whenever there's geopolitical tension or global inflation, investors around the world panic buy Swiss francs. The problem is, if the franc gets too expensive, Swiss exporters, like those famous watchmakers and pharmaceutical companies, they get absolutely crushed because nobody abroad can afford their goods. So to stop their currency from skyrocketing, Switzerland did something extreme. They introduced negative interest rates. Yes, you literally paid a fee for the privilege of storing your money in their vaults. Moving on to Section 2. The unseen engine, the global arbitrage trap. Now that we've established just how bizarre this negative rate environment is, let's look at how Wall Street reacted. And this brings us to the secret loophole that large investment funds, sovereign wealth portfolios, and foreign banks use to quietly inflate assets all across the world. It's called the currency carry trade. When money becomes cheaper than free, smart capital takes advantage. A carry trade is simply the ultimate global arbitrage machine. It's a strategy where you borrow money from a place where it costs absolutely nothing, or crazily enough where they actually pay you to borrow it, like Switzerland, and then you move that money to a place where you can earn a solid return. This is the core financial strategy we're focusing on in this explainer today, because it is the hidden force behind some massive market movements. And this brilliantly illustrates exactly how it works. It's as simple as 1, 2, 3. Step 1. An institution borrows billions in Swiss francs at zero or negative interest. Step 2, they instantly convert those francs into US dollars or euros and they buy high-yielding assets overseas, stuff like American tech stocks, European real estate, or US treasuries yielding around 5%. And then, step 3, they just pocket the difference as virtually risk-free profit. It's an incredible free money loophole for institutional money. But the sheer scale of this, that's what's truly staggering. We aren't talking about a few hedge funds making a quick buck here. We are talking trillions of dollars in global assets, from US stock indices to commercial property, that were quietly inflated by this endless stream of borrowed Swiss liquidity. Essentially, Switzerland exported its capital to the rest of the world, just to keep its own currency artificially low. They basically became the world's hidden ATM. Which brings us to Section 3, the catalyst, the central bank dilemma. But here's the thing. Every ATM eventually runs out of cash, or the rules of the game change. This seamless system worked perfectly until global economic conditions dramatically shifted. When global inflation erupted recently, central banks everywhere started raising interest rates aggressively. And suddenly, the Swiss National Bank faced an unavoidable, deeply painful binary choice. Option 1 was to keep interest rates depressed, but doing that meant their domestic banking system would just bleed capital. Everyday Swiss savers would get destroyed by imported inflation, and domestic asset bubbles would expand out of control. Or they could go with option 2, let the Swiss franc appreciate and raise yields. The huge problem with option 2 is that it makes those trillions of dollars in global loans drastically more expensive to pay back. When forced to choose, the central bank realized option 1 threatened their very own domestic stability, so they chose option 2. They stopped suppressing their currency.
Now let's move to section 4, the domino effect, the global unwinding.
That decision is exactly what ties a boardroom in Zurich directly to your retirement account. Let's see how this builds. The moment the Swiss central bank chose option 2, they triggered a massive causal chain reaction. When Swiss interest rates rise, every single fund that borrowed in francs is forced to repatriate their capital, and fast. Step 1, to pay back their loans, these global institutions have to aggressively sell off their foreign assets, your US stocks, your European bonds, and real estate. Step 2, they take those dollars and convert them back into Swiss francs. But look at step 3, that massive surge in demand for francs pushes the Swiss currency even higher, which in turn makes the remaining debt even more expensive, forcing even more funds to liquidate. It's a vicious, accelerating cycle. This triggers what we call a mechanical sell-off. You know, when you see the market tanking, you might instinctively wonder if a company just had a really bad earnings report. But in a mechanical sell-off, the underlying asset quality doesn't matter at all. An American tech company could literally report record profits. But if the institutional capital holding its shares needs cash right now to cover a Swiss funding squeeze, that stock gets sold regardless. It's a completely blind sell-off driven entirely by the hidden financial plumbing.
This leads us to section 5, historical proof, the shockwaves.
If this all sounds a little bit theoretical, well, history shows us exactly how this pattern plays out whenever this safe haven vault rapidly reclaims its capital. Just look at the consistency here. Back in 2008, a massive spike in the franc coincided with the unwinding of cross-border mortgage debt across Eastern Europe. Then, in January 2015, the Swiss National Bank unexpectedly unpegged its currency, which caused the largest single-day currency shock in modern history, wiping out major brokerages overnight. And in 2020 and 2022, sudden surges in Swiss capital inflows perfectly presaged sharp liquidity pullbacks in broad stock indices. The data is clear. Massive global volatility consistently follows the unwinding of this specific carry trade.
Finally, section 6, conclusion, the structural realignment.
So what does this actually mean for us today? Well, it doesn't mean global financial markets are going to collapse tomorrow, but we are absolutely entering a new reality. The era of free money sourced from negative yield safe havens is officially over. For decades, the global economy relied on this artificially cheap capital to inflate asset prices, but now we're shifting toward a period of higher capital costs and much tighter liquidity. Understanding these hidden plumbing systems is exactly what keeps you ahead of the market noise when those unexplained pullbacks occur. Which leaves us with this final, really vital question to consider. The era of free money is over. Where is your portfolio exposed? Next time you see sudden market drops without an obvious headline, remember to look beneath the surface at these international capital flows. The hidden engines of global finance are shifting gears. It's time to make sure you're ready for the road ahead.